Sure. So we just updated our factor scorecard. So we have value as number one, low volatility as number two. Those two factors we favored for several months now. They continue to work, so we continue to stick with them. They have very strong trends, sometimes called factor momentum, which has us sticking with them. And value is an interesting thing. So value, really started 2022 red hot. Came out of the gate first month of the year, flying higher. We wrote a note towards the end of January that said, value is very overbought right now. We could see some consolidation. We basically have seen that over the last, call it, month. So it's not overbought anymore, and we think the uptrend can continue here.
All right. So when we look at some of the gains in the market today, there are a lot of people who sort of would cheer this and say, oh, okay, maybe the worst is over. But there are also a lot of people that look at this as maybe a bit of a head fake. For those people who are looking for a little bit of shelter out there, are there kind of factor combinations that they can point to?
Sure. So we just came out with a note today, actually. We're looking at what we call our multi-factor model portfolio, which identifies stocks with the best factor combinations and also certain interesting factor combinations. So going back to what I was saying, value and low volatility, looking at the intersection of those two factors, that could be a bit of a port, in the geopolitical storm that we are currently in. When we look at how many companies fall into the 20% of cheapest stocks as well as 20% of lowest volatility stocks, the S&P 500, only nine have that overlap. So three utility companies, three stable companies, things like Verizon, Walmart, Archer Daniel Midland, Berkshire, Campbell Soup, not the sexiest names maybe, but things that have been relatively outperforming, we think that can continue.
And Campbell Soup have been under pressure because of some of the inflationary pressures that company might be impacted by. Talk more broadly. I like how you're going deep on the value factor in particular. I mean, it got off to a great start. It has fits and starts, we know, sometimes loved, sometimes unloved. Is it cheap still? Is it good? Is good value there?
Sure. To cut right to the chase, yes, Caroline, it is. Value hasn't worked for a very, very long time, before like the last year or so. So when you look at value factor valuations, they're still very much towards the extremes, so the cheap extremes. So when we look at factor valuations, what we do is we look at the median valuation of cheap stocks and divide it by the median valuation of expensive stocks. The median valuation of cheap stocks on a price to EBITDA basis is about 5.8 times right now. Expensive stocks are about 24 times. If you take that ratio, that's 0.24. That's in the third percentile of observations since 2010, so very cheap. That has averaged about 0.35. So the bottom line is we can see a lot of value factor outperformance just to get us back to average valuation ratios. So a long runway here should be ahead.
All right, a lot to break down. Chris, always appreciate catching up with you. Chris Kane, equity strategist for Bloomberg Intelligence, with our factors to watch on the day. And we are, of course, keeping our eye here on the markets. Pretty much 3% across the board, 4% here if you want to throw in the NASDAQ. We're counting you down to the closing bells here, just a little more than 20 minutes away. Nadia Lovell, senior U.S. equity strategist over at UBS Global Wealth Management. She's going to be joining us to give some insight. This is Bloomberg.